Oh boy, it is not a good time to be a company offering home equity investments or home equity alternatives to reverse mortgages or HELOCs. I came across this on the Newswire. It's from Ballard and Spahr. It's an attorney's firm. And it's revealing that the Massachusetts Attorney General has now sued Hometap, saying the company offers illegal home equity investments that are really reverse mortgages. Remember, it was just a little over 1 month ago that the Consumer Financial Protection Bureau and their spotlight looked at home equity contracts, and they really heavily criticized them. And they feel that these are deceptive while being marketed as an alternative to cash out refinances. But this is just the increased scrutiny of these home equity investment or home equity contract companies and how they interact with the general public. So back to Ballard and Spahr, let's see what they say in their recap. It says that the Massachusetts Attorney General has filed suit against Hometap, saying that they're offering illegal home equity investments that are really reverse mortgages. And this is a similar claim that was made by the Washington State Attorney's General Office against Unison back in October. So let's see what they have to say here. It says that they have allegedly pervasively and systematically violated the state's consumer protection laws, including mortgage and foreclosure prevention laws. And this is going to get them into some hot water. So the AG is saying that Hometap and their companies engaged in illegal and predatory practices targeting the financially vulnerable homeowner. In other words, someone who's house rich or cash poor, saying that the Commonwealth alleges the systematic and pervasive unfair or deceptive acts and practices in conjunction with purportedly a novel financial product which operates to strip Massachusetts homeowners of equity. Well, stripping of equity, let's look into that a little bit further. So this company is saying, hey, we're not a reverse mortgage. You're not incurring interest, unlike a reverse mortgage. So they say you have no payments or interest for 10 years, according to the Attorney General's office. But at the end, you can call it anything you want. There's a big repayment based on the percentage of appreciation of the home. So I decided, hey, let's take a look at Hometap's webpage. And the first sentence is really troublesome. And it says a debt-free alternative to a home equity loan. So let's just stop there for a moment. Debt-free? Well, there is an obligation to repay at the end of the contract. I just don't understand how you can do that. No loans, no monthly payments, no kidding. So the AG is saying that Hometap is claiming that their product makes home ownership a little less stressful. Well, at least in the short term it may, because it's giving them access to a big lump sum of cash. But the AG points out that their product is much more expensive, at least they allege that, than any common mortgage product on the market. I wonder how that compares to reverse mortgages. Then they get a little bit more specific. They claim that the Hometap product devalues a homeowner's equity or erodes it by paying them as little as half of the value of the equity they end up actually taking out. Also, they offer upfront fast cash to those without even evaluating or knowing their financial situation. I think that's important to know. Otherwise, you could put someone in a worse situation. The Attorney General alleges that Hometap markets their product to the house-rich and cash-poor homeowner. That sounds familiar. And the practice, they say, will lead to homeowners being unable to pay the large amount required at the end of the contract. That, the AG says, could put them at the risk of losing their home to foreclosure. They also, and this is probably their most salient argument, that Hometap offers what is in essence really a reverse mortgage, though the company says, no, it's an investment. It's not a reverse mortgage. Now, usually with an investment, you're hoping for some sort of return, not debt or repayment in the future. In the suit, the state of Massachusetts contends that Hometap's home equity investment does not comply with the requirements intended to protect reverse mortgage borrowers. And those include that the loans are only made to those 60 and older, 7-day waiting period or cancellation period, and that they receive third-party counseling. And lastly, they allege that Hometap is engaging in deceptive marketing practices, saying that it invests along consumers and doesn't charge interest. So, okay, it's not interest like a loan, but yes, it's having to be repaid, so wouldn't that be a loan? So the state AG has asked for Hometap to be barred from continuing any continued alleged illegal activities, as well as to make restitution for those who have been harmed by the product. So there you have it. It's not a good time to be a home equity alternative company in today's regulatory landscape. Even without the CFPB really functioning in its full capacity or effectively being defanged, thanks to the efforts of DOGE, state regulators are not going to relent. And so there you have it. Another suit for someone who is engaged in home equity alternative products. And I think it's just better if these folks were to look into a federally insured or even a proprietary reverse mortgage. Last week, we covered how DOGE is planning really to take the axe to the staffing and the budget of the Department of Housing and Urban Development and the Federal Housing Administration. So HUD and FHA have some massive changes coming their way. That video, by the way, generated quite a bit of interest even outside of our industry. And if you'd like to see some of the comments, you can go to our YouTube channel to look for that. But now a leaked internal memo, according to the Washington Post, shows just where these cuts may be happening. And I tell you, it's going to be a big adjustment. So let's go through this together and just see what's cooking when it comes to DOGE and their plans for two of our largest housing agencies, HUD, of course, more in a supervisory role, and then, of course, FHA. So the Post says that there's going to be some big cuts at the U.S. Department of Housing and Urban Development that could impact the housing markets, make homes less affordable, and royal mortgage transactions. We outlined some of our concerns last week. Now, they claim that these changes come amid a national housing crisis. I would agree. We have a housing crisis right now, an affordability crisis, and we have a shortage of housing inventory. So here's the real scoop, according to the Post. It says that current and former staffers, many who spoke on the condition that they remain anonymous for fear of reprisal, say they fear it's going to become very difficult to answer how and when HUD can carry out their core functions as an agency. And those concerns have increased since officials from DOGE, the Department of Government Efficiency, and Elon Musk have made their focus to slash federal spending and regulations. So they showed up at their headquarters, as we reported here at HECMWorld before. Now, today, HUD's entire workforce is projected to drop by half, from 8,300 down to 4,000. And we're going to go into where those cuts may be made, but it's going to be also in the field offices that are spread around the nation. So if you have a HUD field office, in the Midwest, prepare for cuts. Top HUD officials and staff have also briefed the workers of HUD on proposals to evict undocumented immigrants from public housing. Well, I think most Americans wouldn't be too upset about that because we still have homeless veterans on the street, but also impose time limits or work requirements for others that are staying in HUD housing. So that's most likely referring to Section 8. The closure of regional field offices may create some issues, at least for people on a local scale, saying, make no mistake, these employees live in communities across the nation, not just D.C., and they serve in several regional offices that are the first line of support for those in need of help with housing, meaning those that are perhaps needing Section 8 or trying to qualify for HUD-subsidized housing are going to be going to those offices, but they may be closed. Now, more generally, the Post is reporting that billions of dollars of cut in HUD's budget may come from homelessness initiatives, which would be stopped at least temporarily, along with nonprofit distributions and local governments nationwide. So let's look at some of the bigger cuts on a macro level. And first is the Office of Community Planning and Development. Now, they have a portfolio which includes veteran housing, disaster recovery, homelessness, and community block grants, etc. They're going to be slashed by 84% by May. I'm just wondering what the fallout's going to be. Also, the Office of Fair Housing and Equal Opportunity, which focuses on eliminating housing discrimination, will be slashed by 77%. Staffers also say these cuts appear to contrast with Donald Trump's campaign promise to make housing more affordable. We'll see what happens in the end. Now, FHA, the Federal Housing Administration itself, the agency within HUD, is facing potential cuts of up to 40%, according to Bloomberg News, which we reported on at length last week. So, what is the role of our new HUD Secretary, Scott Turner, in these budget reductions? Well, more of the direction, says the Post, is actually coming from Scott Langmack, a DOGE senior advisor to HUD, who previously worked as the chief operating officer of Kuchen, an AI-powered property technology platform. So that would lead us to believe that they are, in fact, using AI to perhaps consider which areas need to be reduced. We're going to continue to closely monitor these developments. And also, if you have not seen our video from last week, it will really help you catch up and understand just some of the potential cuts that DOGE will be doing and the potential impacts on FHA, more specifically to the reverse mortgage. So you can find that at HECMWorld.com. And this week, we bring you our monthly installment of Reverse Market Insights Market Minute with John McHugh. And by the way, if you're not familiar with RMI's content, I would strongly encourage you to go and at least subscribe to their newsletters. And that is giving you some great insight. It goes into a little bit of different detail than we do in our top 100 retail HECM lenders report. So again, we're glad to have John with us. And John, I know we've had some legs when it comes to data from the government, especially with everything going on. What do you have for us this month?
Well, thanks, Shannon, for having me back again another month here. This is going to be a slightly different segment than I've done in the past as well. I know last month was definitely different. This one's going to be a little different as well, just because we are still lagging the comprehensive data that we normally use for these segments from HUD. However, we do have kind of a more broad general data set that that they do put out. So we do have that for January. So we're going to go ahead and look at what happened in January, kind of talk about a little bit what I might be expecting, as far as February is concerned also. But as far as January is concerned, we did have a slight uptick from December, up over just 0.5% to 2,641 endorsements. Half of the regions that we track were actually up from December, with the Rocky Mountain jumping over 22% to 263 loans. New York, New Jersey, after 2 strong months in a row, actually was showing the highest volume in over a year, with over 17% in growth, up to 138 loans. In the Southwest, just missed double-digit growth, growing 9.5% to 253 loans. Another fun fact for you, when we compare January 24 to January of 25, all the regions with the exception of the Great Plains were actually up from the same time last year. So there is some additional positive notes in there also. As far as our top 10 lenders are concerned, really similar to the regions. Half of them actually showed growth, so 5 of the 10 were up. With Good Life TMAC more than doubling their volume for December, leaping over 113% to 179 loans. In fact, it's their highest volume in over a year, so that's great. Guild grew over 87% to 105 loans, and then FAR, Longbridge, and Liberty were all up between 2 to 7% to hold their places at the number 2 through 4 spots. So to recap kind of things, first, obviously, we were up from December, but it was really only by 15 additional loans. But it was positive, so that is good. What we do know is that starting in late, Q3 and into Q4, the interest rate started to shift up. The CMT started to move up. So we really should start expecting some decreases in endorsements, for the next few months. My guess would be that with February being a slightly shorter month, and with the rates having gone up, a couple of months ago, we could potentially see a drastic decrease. Hopefully, it's more gradual than that, but we haven't had any new application data since October of last year, which is really our indicator of future endorsements. Since that data was published, it's actually been removed off the website. So there's only September data actually published out there, but we do know what application data did look like through October, which all of that was positive. So that is good. But what would have been interesting is see what happened in November and December, and then obviously into January, just to see how the rise in the rates had any impacts on those. So with that being said, the rest of the year really should be very interesting to see what happens with rates and obviously everything else that's happening out there right now. So tune in next month to see how the endorsements fared in February.